Stock market volatility is heating up. In fact, it's running high, and it could send paper hand investors running for the hills. But it could also provide long-term investors like you and I opportunities. If you stick around for the entire video today, I will be discussing my 3 top dividend stocks to buy in the month of March. Some of these names, in fact, I have added to as recently as last week. Let's take a look. For those of you new to the channel, my name is Mark Rushin. I'm a CPA and not a financial advisor, so please perform your due diligence before investing in any stock mentioned in the video today. As always, everything mentioned on this video is for educational and informational purposes only. If you are looking for a new investing platform, M1 Finance has one of the best platforms for long-term buy and hold investors like yourself. If you check out my link down in the description below, they are giving away $50 free just for opening a new account, so definitely check that out. Also, do not forget to sign up for my weekly Dividend Investors Edge newsletter that goes out every Monday morning. All right, if you love dividend stocks just like I do, and you love the idea of passive income, then do me a huge favor and click that like button down below, as it helps this channel out tremendously. It costs you nothing. I put these videos out here for free, so please do me a favor and just click that like button, as it is a huge help to the growth of this channel moving forward. All right, let's dive in to the 3 dividend stocks to consider buying in the month of March. The first dividend stock to consider for the month of March is Lowe's company, stock ticker LOW. As you probably already know, Lowe's is one of the largest home improvement retailers alongside Home Depot here in the US today. As a disclaimer, I've been a huge fan of both of these stocks for a number of years, but in today's video, we are just going to discuss Lowe's. Lowe's has been on quite a turnaround over the past few years, when new CEO Marvin Ellison took the reins in July of 2018 and simply breathed new life into the company. In fact, since taking over in 2018, shares of Lowe's are up over 130%. I loved it back in 2018 when Lowe's announced that Marvin Ellison would be the new CEO of the company. This is due to the fact that Marvin Ellison knows exactly what makes Home Depot tick. Home Depot, one of the gold standards of efficiency, not only in the home improvement sector, but in the entire market. The company is just, the way it runs and ticks is almost perfect. And Marvin Ellison knows this because he worked as an executive for 12 years at Home Depot before becoming the CEO of JCPenney and then moving on to Lowe's. As I had mentioned, Lowe's shares have increased 130% since Marvin Ellison took over, and during that same time span, Home Depot shares have gained 60%. Let's take a closer look at the stock. Shares over the past year are up 38% and trade at a market cap of $146 billion. For comparable purposes, Home Depot has a market cap of $330 billion. The current valuation is rather intriguing, as the company has a forward earnings multiple of 16.3 times compared to a 5-year average of 20 times. This is using the updated 2022 guidance, where growth is expected to slow. The pandemic provided a huge boom to home improvement projects, and although that is slowing, it will not be going away that fast. The housing market is still hot, but also slowing as rates are rising. But I am of the belief that this will lead to more people that were on the fence about potentially moving, choosing to stay and doing DIY improvements on their current homes, which is a boom for Home Depot and Lowe's. In terms of the dividend, the company currently pays a dividend of $3.20, which equates to a dividend yield of 1.46%. The company has a very low payout ratio of 25% and a 5-year dividend growth rate of 17.67% per year. and a very long history of dividend growth. The company has increased the dividend for 58 consecutive years now. So this is a company that's on the very prestigious Dividend Kings list with over 50 years of consecutive dividend growth. They've increased their dividend for that number of years, and they still have a low payout ratio. This is a testament to the company that Lowe's is, and the future of dividend growth is strong with this company. So definitely take a closer look at Lowe's for your dividend portfolio. The second dividend stock we're going to discuss today is Microsoft, stock ticker MSFT. Microsoft is one of the two largest companies in the world, with a market cap of $2.2 trillion, only trailing Apple, who has a market cap of $2.7 trillion. We're speaking with T's here and not your normal B's. In fact, Microsoft and Apple make up over 13% of the entire S&P 500 alone. As you may already know, it's much easier for smaller market cap companies to expand and grow their multiples than it is for large companies. But we are talking about the largest, one of the largest companies, yet I still believe that they have plenty of tailwinds that'll lead to further growth in the near future for Microsoft. It really comes down to the quality of the company. There's a reason that Apple, Microsoft, Alphabet, Amazon continue to grow and get bigger. They are well-run companies with strong market segments. Microsoft has been in the news recently, as in January they announced the $68.7 billion acquisition of Activision Blizzard. This is after accounting for the company's net cash position. This is by far the largest acquisition in the company's history by a wide margin. The next closest acquisition was in 2016 when Microsoft acquired that of LinkedIn for $26.2 billion. Microsoft is not very well known for their dividend, but much of this has to do with the growth of the company over the years and the growth of the share price. If you recall, dividend yield has an inverse relationship to stock price. As a stock price goes up, dividend yield comes down. As a stock price goes down, dividend yield goes up. Over the past 5 years, shares of Microsoft have increased 360%. On the flip side, the dividend has increased at an average annual rate of 9.5%. So you're getting pretty solid dividend growth, but it can't keep up with the strong share price appreciation. So it really seems like a stock with a relatively low yield. Looking at this graph, you can see that while the price has been climbing, the yield has been falling. The company has increased the dividend for 18 consecutive years now. Microsoft is a highly profitable company, and they have plenty of tailwinds still. They're the second largest cloud player behind Amazon's AWS. And with this Activision Blizzard acquisition that is expected to close in the coming years, this is a boost to the consumer segment, as Microsoft already has the Xbox console and many games are moving to cloud. So this is just going to enhance that as it brings on big time games such as Call of Duty. With shares down 15% from the highs we recently saw, I added to my position of Microsoft in the past week. Dividend stock number 3 is Chevron, stock ticker CVX. Chevron is a multinational energy conglomerate, one of the largest in the world, with a market cap of $273 billion. This isn't just an ordinary energy stock. This is one of the largest in the world. And also it's one of the largest stocks held by Warren Buffett's Berkshire Hathaway. Just this past quarter, a filing with the SEC showed that Berkshire Hathaway added another 9.5 million shares of Chevron, worth roughly $1.3 billion. You can see that this follows another sizable purchase in Q3. So clearly, Warren Buffett and company are very bullish on this energy conglomerate. Berkshire's current position in Chevron is worth an estimated $5.5 billion and has a top 10 holding within the Berkshire portfolio. Warren Buffett loves dividend stocks, especially dividend growth stocks, companies that continually show that they can increase their dividend year in and year out. And Chevron is no different. Chevron currently pays a hefty 4.05% dividend yield, and the company has increased their dividend for 35 consecutive years now, and they have a 5-year dividend growth rate of roughly 5%. Dividend growth companies could tend to have lower yields, but if you're an investor looking for income right now and higher yield dividend stocks, then definitely take a look at Chevron. The company is flush with free cash flow, the mark of a strong dividend paying company. So I fully expect that Chevron will continue to increase their dividend moving forward. High yield sometimes could mean slowing share price appreciation. However, over the past year, shares of CVX have climbed 37%, and they have increased over 160% since their pandemic lows in March of 2020. Chevron has often traded the way of crude oil prices, and currently crude is trading close to $100 per barrel, and Chevron is trading at their 52-week high as well. So you may be asking yourself, Mark, why are you suggesting I look at a stock that's trading at its 52-week high? Just because a stock is trading at or near its 52-week high doesn't mean it can't go any higher. It always comes down to valuation and the growth potential. Currently, shares trade at a forward earnings multiple of 12.7 times and a price to cash flow from operations of 9.4 times. Looking at the chart, you can see where shares have traded in terms of cash flow over the past 3 years. Although the stock price has been climbing, the cash flows are growing at a very strong clip. So it may be indicating that the share price has not yet caught up to the cash flows. And considering the 5-year average of cash flows from operations is closer to 10.5 times. And oil isn't the only thing that Chevron does. They have upstream and downstream activities, and the company is a very large conglomerate. But definitely take a closer look at Chevron because they're going to pay a much higher yield than the other stocks that we mentioned today. Albeit you're going to get slower dividend growth, but you're also going to have a totally different industry that you're going to be investing in. Higher yield, strong industry where energy has been performing very well, and it's expected to continue performing very well. And it's also backed by Warren Buffett's Berkshire Hathaway. So there we have it. 3 dividend stocks to consider looking at adding to your dividend portfolio here in the month of March. All 3 companies have a few things in common. They pay a dividend and they pay a growing dividend. A consistent growing dividend is what I look for as a dividend growth investor. If you haven't done so yet, please again hit that like button. I hope you enjoyed the video, and we will see you next time. Take care.